Let's get your trading day started. Live from New York City this morning. Good morning, good morning. Your equity market, what a month in November. Can we add some weight to it? Equity futures up 0.25%. A countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, stocks and bonds close out the best month of the year. Saudi Arabia pushing OPEC to constrain supplies, and Elon Musk has some choice words for advertisers. We begin with the big issue, the everything rally. Check it out month to date. What a move in this equity market. On the S&P, up by 8.5%. On the Nasdaq 100, the best month since July of last year. Double-figure gains. And look at this. The two-year yield down more than 40 basis points in November. The two-year on October 19th was 5.2571. Right now 4.6864, and we have had a 61 basis point move lower on a 10-year. 4.3225. Equities rip, treasuries rally, yields drop. Can this continue? Joining us now to discuss is JP Morgan's Priya Misra, Krishna Mamani of Lafayette College. Priya, let's get straight to it. Can this everything rally continue next month?
Sure. Thanks, John. So, I think this has been all this immaculate disinflation, soft landing. Essentially, that's what's priced in. So, the risk to this would be either that inflation does not decline in a straight line. I'm somewhat sympathetic to that last mile issue. And I think the market's a little bit run with the idea that the Fed will be cutting rates, even with the unemployment rate, around 4%, because inflation's going to be down to 2%. I think that's a risk here that we should monitor. I'm going to be watching every inflation print. The other risk is that it's not immaculate, meaning that the economy actually can slow down faster. In that scenario, the Fed does cut rates. So I think we remain in this bimodal world where soft landing, I think the Fed stays here for a while. Hard landing, the Fed will have to cut a lot more. But in both these scenarios, I think this everything rally remains challenged. But, we're heading into the end of the year. If the economic data remains okay, which we think right now it is okay, we're in a soft landing right now. I think, the market can continue to be in this FOMO world. I think people didn't own enough duration risk. People didn't own enough credit risk, enough risk assets. Everyone, cash has felt good this year. So I think that's why this FOMO rally, in a way, can continue into year end. But I think as we think about next year, we should be mindful of those two risks. Does inflation come back down enough to 2% or below to allow the Fed to cut? And does the economy hold up? I'm sort of nervous on essentially both ends of that risk spectrum.
Let's unpack that. You made two broad points there. One on the fundamentals, the second was on positioning. Krishna, let's talk about positioning. You and I have talked about the path of least resistance through the year, and I remember very early on in 2023, you said the upside risk was the biggest risk here. That was the path of least resistance for equities. Krishna, do you still share that view, given the reversal we've seen, the big rally we've seen over the last month?
I think the big rally last month was because of big correction in September and October. So if you kind of go back, we have been here, not exactly here, but not too far from here either. So I think the outlook for December and January, for that matter, I think is we are still in a trading range. As Priya said, there are lots of data points to kind of be cognizant of and therefore monitor how things unpack, because the path of inflation and the quickness of that path down, I think is going to be critical. Having said that, I think if you have a one-year investment horizon, and at this point it's probably the right investment horizon to have for 2024, there are a whole lot of things that can fall in place rather well. So let me highlight that. That is, you can have an economy that does reasonably well. Not 5%, but 2% is definitely in the cards, given the momentum in the economy and where employment is. Second, inflation continues to come down. And I think the risk of inflation ratcheting back up at this point, based on all the things that we have seen, despite Priya's concern, I'm somewhat more sanguine. The more and probably the most critical thing in my judgment is where real rates are. Real rates today are 2.5%, let's say, rough terms. There is absolutely no reason for an economy growing at 2% that real rates have to be at 2.5%. They don't have to be negative, they don't have to be zero, but they don't have to be at 2.5%. If that comes down to 1.5%, I think the outlook for risk assets in 2024 can be substantially better than what we can foresee today.
Priya, let me give you some time to respond to that. Just on the last point, what are your thoughts?
Sure. So I would agree with Krishna. I think for risk assets to do well, those real rates have to come down. What helps real rates come down will be the Fed having to start to cut rates. So is the soft landing predicated on the Fed starting to cut rates? I think the market loves that idea. I'm not so sure that the Fed will be that quick. I mean, they've lost a lot of inflation credibility. They want to put that inflation genie back in the bottle. Either the unemployment rate, I think, closer to 5% or inflation at 2%. And I know inflation's been coming down significantly. If that decline starts to stall, I would argue that the Fed's going to be the bar for the Fed to cut rates is high. So we may be in this uncomfortable position where we want those real rates to decline, but how do you get it to decline? We need the Fed to respond. And I think right now they're going to be happy to just buy time, wait for data. And until inflation doesn't get to 2, I don't think those real rates come down significantly. So I think that's why that's going to be a risk for the market looking for these lower real rates. But absolutely, I agree with Krishna. I think 2.5%, 2% real rates, the economy can't handle. And so at some point, those lags that we've talked about for the last 2 years, I think those lags start to play out, things start to slow down. Everyone will watch the Fed. Can they be preemptive? I just think the era of a preemptive Fed that's cutting rates to try and engineer that soft landing, I think that's behind us.
We're all looking for Chairman Powell about 24 hours away. Let's get to Mike McKee for more on the Fed speak. Morning, Mike.
Good morning, John. It'll be interesting to see if Chairman Powell pushes back on this market idea that we're going to see rate cuts fairly soon. The numbers all suggest at this point that we're seeing a possible soft landing scenario. The Fed's not going to embrace that quite yet. You see jobless claims moved up just a little bit. Continuing claims moved up more than anticipated, suggesting people are having a harder time getting new jobs if they've been laid off. And we did hear some of that in the Beige Book yesterday when the Fed said that some companies are reporting they are not filling jobs through attrition, and some companies are actually feeling okay about maybe letting some people go. Personal income, interesting story here, up 0.2, half of what it was the prior month, but wages up only 0.1%, and that is the lowest since last December. They accelerated again, but maybe that takes some of the pressure off inflation. They look at PCE inflation, everything's come down, headline and core, and the super core that Jay Powell likes to look at. Mary Daly just out on the wires with an interview in a German newspaper suggesting the Fed cannot say that it has defeated inflation yet, and we are not talking about rate cuts. But yes, they are. The dot plot that they put out in September suggested they're going to cut rates this coming year. It's only a question of when, not the fact of if. And if we see the real rate continue to rise, it may come sooner. And the real rate would rise because inflation comes down faster. So what we're really talking about here is what Wall Street's prediction is for the path of inflation. There could always be a recession that would cause them to cut rates, but right now the data we're getting, John, don't suggest that that is the scenario ahead.
Mike, thank you, buddy. Always enjoy catching up with you, sir. Jobless claims speak to that. Jobless claims at like 218, still exceptionally low. A bit higher than the previous week, but exceptionally low on a historical basis. Chairman Powell tomorrow. Here's Citi's Andrew Holdenhorst. Powell has an opportunity to push back against the cuts priced in when he speaks on Friday. They call it a significant risk, but, and a big but, if his colleagues are any guide, Powell's pushback will be limited and risk-on conditions will continue. Krishna, do you agree with that assessment?
100%. I think if you kind of think about it, the biggest hawk out there and probably the most credible hawk out there is Waller. And he basically laid out the path with the Wall Street Journal interview, which is if the current trends continue, and he was even more specific, 3, 4, 5 months, he doesn't see policy rates remain at current level in that sort of an environment. So and Williams has been saying that for a long time. So I think both sides of the FOMC have indicated, and as Mike McKee pointed out, they have actually put it out there in their forecast. I think we have to take them at their word. That is, what we should be looking for is the trend in the data. And if the data continues on the current path, saying that they won't do anything by, let's say, May or June of next year, I think it's kind of making certain assumptions about how things will work out on the data front.
Well, Krishna, we've got to make some assumptions. That if, let's talk about that if in that quote you shared from Governor Waller. How big is that if these trends continue? The communication we've had from the Fed this week, Waller, something is giving. It's the economy. Bostic, downward inflation trajectory will continue. Priya, just how much disinflation is already in the pipeline over the next few months?
Sure. So I think the base effects are essentially going to move that year-over-year number lower. The fact that, we're coming off high inflation prints. But I still go back to the labor market. The labor market is tight. Wages are coming down. But I think where wages are is not consistent with the 2% PCE number. And that's why I think when the Fed thinks about inflation, there's absolutely disinflation in there. The supply side, demand side started to come down. But are we consistent with 2%? I think they really want to keep inflation expectations anchored, and they don't want a significant easing in financial conditions. So I think what they're going to say is there is a path for the Fed to cut rates. That path requires inflation convincingly at 2%. And the other path, I think they're not talking about that. The market should price in the other path, which is even if inflation's above 2%, if that unemployment rate starts to get dangerously north of 4%, they may have to cut. So I think we're still going to be debating this hard landing, soft landing. I know the data is looking very soft landing-ish, but it's all predicated on that inflation that's been declining. And I think I think Chair Powell's going to hedge a little bit and say, we're not talking about cuts here. We can cut, but we need that inflation convincingly closer to 2% from the labor side as well.
Priya, what I hear from you is that the bar for cuts is higher than people think. And I think what the media always obsesses over is calendar-based guidance, calendar-based calls. Tell me, is it May? Is it June? Is it somewhere next year, the second half, the first half? I want to talk about threshold-based guidance. Priya, what are the thresholds? You alluded to them just there. I suggested earlier this week, based on research from Standard Chartered, that maybe it's 4%, 4.5% unemployment and core PCE at 3%. That was their call. What are you saying it is?
So I would say anything above 4.5 will make them nervous on the unemployment rate, with an if that's not driven by participation going up. If this is, negative payrolls or zero payrolls for a few months, you're going to get that rise in the unemployment rate. The Fed thinks NAIRU, or the non-accelerating rate of unemployment, is about 4%. So if you're significantly above that, 4.5, 4.75, I think they start to cut rates. They might even ignore inflation above 2.5 in that scenario, because inflation, we know famously, is lagging. And so if the labor market's weakening significantly, I think they cut rates. But in the scenario where we're in right now, the unemployment rate around 4%, I think they need PCE much closer to 2% or almost below 2% for them to start to cut rates. I think the Williams-Waller argument of keeping policy at the same level of restrictiveness requires an assumption on R-star. And we've all become a lot more humble on what exactly R-star is. And so I think the Fed will want clear signs that the inflation is not above 2% before they cut. So I can see the two states of the world. I think 4.5 or 2, a combination of that will allow them to cut, to keep policy at the same level of restrictiveness. We're not there on the inflation front.
Priya Misra sticking with us alongside Krishna Mamani. We are about 17 minutes out from the opening bell to close out the month of November. Equity futures positive here by 0.2%. Let's get you some movers. Here's Abby.
Good morning, John. And adding to the bullish tone, we do have a few movers to the upside, starting out with the shares of Salesforce.com. They are popping sharply higher. This after a third quarter beat right across the board, in particular, 19% profit beat. It is seen as a low bar quarter, so expectations were low going into it, but they exceeded. They also raised the profit outlook, perhaps having to do with the jobs cuts that were announced over the recent last year. Morgan Stanley, though, does have some questions on Gen AI for 2025. Snowflake, a similar deal, up 7.3%. They beat and raised for that cloud company, offering some hope for revenue stabilization after a slowdown. And then Tesla, it had been up more than 1%, right now up about 0.3%, of course, after Elon Musk's bold, wide-ranging interview at the New York Times Deal Book Conference ahead of today, which, John, of course, I know that you're excited for it, is the big Cybertruck event.
Yes, very much so. Abby, thank you. We'll catch up with Ed Ludlow on that in just a moment. Coming up, US automakers making their pitch to Wall Street.
We never thought that the EV adoption would necessarily be a straight line. We've seen this in other markets. We're seeing it now in the U.S. But I think the thing that everybody has to remember, if the growth is slowing, it is still growing.
New guidance from GM and Ford in the past 24 hours. That conversation up next.
We never thought that the EV adoption would necessarily be a straight line. We've seen this in other markets. We're seeing it now in the U.S. But I think the thing that everybody has to remember, if the growth is slowing, it is still growing. We think we're going to see a strong adoption for our products. And as the charging infrastructure continues to be more robust, we think that's going to drive adoption, as well as having affordable EVs.
Much more difficult than they expected. The race for EV domination heating up. Legacy automakers struggling to sell EVs at a large enough volume to compete with Tesla, dealing with production issues and downshifting plans for factory openings, citing low demand. But GM and Ford both insisting an EV customer base exists. Your team coverage starts right now. Bloomberg's Katie Greifeld and Ed Ludlow joins us. Katie, good morning.
Good morning. And yeah, those question marks over EV demand help explain why you're seeing pricing come down both at Tesla and these legacy automakers. From your interview this morning with Ford's CFO, John Lawler, he said that they've seen EV prices come down, quote, much quicker than we expected. And that's because while early adopters were willing to pay a premium here, that's not necessarily true as the EV customer base broadens out. And as such, Lawler, he expects that EV prices will equalize with gas prices. He also said that fewer than half of sales will be EVs by 2030. Now, GM also dealing with that stalling EV push. That's a production story as well as a demand story for GM. Trouble at its battery pack facilities has kept EV production in the low thousands. You think about how many cars Tesla sells, and there is a lot of gulf there. GM's Mary Barra said yesterday that GM should have those issues fixed by mid-2024. And that timetable is important given that EVs, they're a big piece of GM's strategy to double sales by 2030. So we'll see how that works out, John. I will just say, though, that range anxiety is real.
It's a real thing. It's a big deal. Ed Ludlow, Tesla seem to be doing OK, though. And I just wonder if they're still in the driving seat after these additional costs come through for GM and for Ford.
Yeah, they've kind of continued to extend the gap as the market incumbent in electric vehicles, despite all the chat for 4 years, basically, or probably going back to 2019, that legacy auto would catch them up. It's why the Cybertruck event today is so significant. You know, I remember being there in Los Angeles 2019 when this edgy Cybertruck rolls on stage, no one in the room really believing that's it. And Musk, in classic style, promised that he would change the pickup category. Yes, he's behind his own timeline and schedule, which is pretty common for him. But this is a really ambitious product. And it's one where you look outside the traditional barometers of demand, look to social media, look to the commentary, the image sharing. And there's a lot of excitement around this. It's going to be low volume at first, and there's been brilliant coverage by my colleague Dana Hull on how Tesla has once again started with the technologically most challenging version of a pickup truck and plans to ramp it slowly. Musk said 250,000 units maybe by 2025. It's going to be incredibly difficult because of its complexity and the materials with which it's made. The pickup is sacred in North America, John, as you know.
Yeah.
And it's going to be interesting to see how big a dent this makes into the big legacy OEMs.
Big day for the company. Ed, thank you. Ed Ludlow there alongside Katie Greifeld. Priya Misra, Krishna Mamani back with us for some final thoughts. Let's build on what we were talking about, disinflation, the auto sector cutting prices, Walmart only a few weeks ago talking about deflation in the pipeline. Priya, Goldman Sachs in their outlook for next year said the hard part was over. Is the hard part over? Or is that still in front of us?
I think the hard part of getting inflation from 5% to 3%, I think that's over. I think the hard part is upon us now on the growth front, because does this immaculate disinflation, getting that inflation from 3% to 2%, getting wages down with a tight labor market, I think that's where, with the lags coming in, you know, you're seeing cracks in the consumer balance sheet sort of starting to pick up with more credit, credit card buildup, with higher delinquencies. I think that hard part is upon us, which I think the market's not priced in at all. You know, I think we're in the soft landing, the market's pricing in that soft landing. So when you talk about the hard part, I think, can the economy withstand and bring inflation back down to 2%? keeping growth where it is, or does growth start to falter? And at that point, I would argue every hard landing starts looking like a soft landing first.
Yep.
You know, is that the risk that growth slowing stalls here, or does that just continue to accelerate? Recessions are always nonlinear.
These are the questions your colleagues in the investment bank are asking as well. JP Morgan on the investment banking side of things in the research team, 4,200 price target. Krishna on the S&P 500 with a downside bias. Part of that call to what Priya is talking about, the market is assuming a near perfect landing with inflation cooling without a significant impact to demand and pricing power. Krishna, can those dreams be realized?
So I would kind of respond to what Priya was saying, that every soft landing looks like a soft landing as well. The point is, things are moving in that direction, and we really have no data point other than pure conjecture to speculate that that won't come about. And I think the other key point to remember in that regard is the fact that the one thing that Fed is far more focused on right now than it was in, let's say, 21, 22, when they were dealing with a real big-time inflation issue, is they don't want to extract a loss from the jaws of victory. That is, they have done a lot, and they cannot afford, I think, from their credibility standpoint, to continue to overdo it and get the economy in a recession. So I think when the data gets slightly muddled up, they are probably cutting rather than not cutting.
Krishna, appreciate your thoughts. Fantastic panel this morning alongside Priya Misra, Krishna Bamani. Coming up on this programme, the morning calls and later, Citi's Stuart Kaiser making a case for another year led by big tech. But, and it's a big but, he thinks this rally is built on good data, and when that data starts to turn, you should turn away as well and run. That conversation up next, your opening bell, 7 minutes away. We are about 5 minutes out from the opening bell. Good morning to you. Equities doing okay on the S&P 500, positive here by about 0.2%. Going into that opening bell, let's get you some morning calls. Your first one coming from the team over at Jefferies. Upgrading Pinterest to buy, $41 price target, seeing catalysts for upside revenue growth next year. That stock is up by 2.2%. Your second call from Wolfe Research, upgrading Ali Financial to outperform, expecting the company to benefit regardless of the economic environment, positive there by 2%. And finally, Morgan Stanley, upgrading HP Enterprise to equal weight, pointing to an attractive valuation and upcoming opportunities within AI. That stock is positive as well by almost 2%. Coming up, Citi's Stuart Kaiser expecting another big year for big tech after a monster month for the Nasdaq. That conversation up next. Your opening bell just around the corner. The last trading day of the month. Favourite quote of November. Jack Caffrey, JP Morgan. What a year this month has been. What a year this month has been on the Nasdaq. Double-digit percentage point gains on the Nasdaq 100, up something like 11%. Right now, just about unchanged on the Nasdaq, just about unchanged on the S&P 500. The equity market bulls want November to go on forever. There's your opening bell. Switch to the board and get to the bond market. Yields look like this on a 10-year. This morning, higher by 6 basis points. On the month, down by something like 60. Down something like 60 basis points and down something like 70 from the highs of October 19th, where we were looking at 5% on a 10-year yield. In the FX market, the euro 109.15. We're negative on a session by 0.5%, but the euro on the month heading towards the best month of the year. Just like the equity market, the dollar a whole lot weaker, worst month of the year for the dollar. The euro on the month up by about 3%. Incidentally, the best month for euro dollar if we close like this going back to November of last year. Elsewhere in the commodity market, we'll be talking about OPEC Plus in just a moment, up by 1.4%. WTI crude just south of 79, 78.93. About 45 seconds into this session, we're positive by 0.1% on the S&P 500. The Nasdaq up by 0.06%. One stock to watch at the open, Salesforce. Cost-cutting measures helping the company deliver better results. Abby has this one. Hey, Abby.
Hey, John. Yes, and investors are really liking these results. The stock right now is having its best day since March of this year, really cheering what is considered also to be a low bar quarter that the results beat specifically across the board. But it was mainly profits, adjusted earnings by 19%. 19%. They put up $1.38 in adjusted earnings. They also raised the profit range, the outlook, but you just mentioned the cost-cutting efforts. In August, they cut jobs. That followed a 10% staff reduction earlier this year. The goal was profitability. They achieved it, revenue beating, but just very slightly. Now, one part of the raised outlook is being called better than feared by Morgan Stanley, but Morgan Stanley is also questioning to some degree Gen AI, their strategy into 2025. So again, this is a better than feared result because the stock is still down about 20% from its 2021 peak, even though it's up 73% on the year. And that declined from the peak, John, even with today's pop.
Abby, thanks for that. Let's turn to the autos, shall we? Ford lowering its profit outlook due to rising labour costs for UAW staffers. Simone Foxman on top of this one. Hey, Simone.
Hey, John, your shares higher, but not by too much in early trading. For profits for 2023, the company now looking at $10 to $10.5 billion. It had seen $11 to $12 billion as recently as July, but remember that Ford's suspending its guidance in October in the midst of that UAW strike. Citi calling this encouraging, saying the company is tracking towards the higher end of its guidance before the strike. But of course, those labor costs going to come into play. And we got some word of how these labor costs are going to play out over the 4+ years of this UAW contract. They're going to cost the company $8.8 billion over its duration, translating into $900 a car. And John, now I know you brought this up with the Ford CFO this morning, especially comparing to the $575 a car that GM said it will see yesterday. Ford, of course, going to try and mitigate this through cost cuts, productivity increases. But, you know, the comparison to GM is really there, and that's why we're seeing shares actually now lower. Remember, we saw a huge surge in shares in GM yesterday when it reinstated its 2023 guidance, so we're moving in the opposite direction.
It's kind of bizarre. Of course, Simone, the one thing we didn't get from Ford this morning that we did get from GM was just a monster buyback. But forgive the pun, you could drive a truck through the guidance, the difference between what you heard from GM and what you heard from Ford, which makes you wonder, and I was thinking this morning, is one being a whole lot more transparent or conservative about how much this is going to cost than the other. Simone, thank you. Lots of attention on something else this morning. Elon Musk, the owner of X and a whole lot more, dropping some choice words for advertisers. Ed Ludlow has this one. Hey, Ed.
Good morning, Jonathan. There was an apology on stage from Elon Musk at the New York Times Deal Book Conference for that November 15 post. He added that it was the worst and dumbest I've ever done, quote, in reference to that post, which at the time was seen to amplify the anti-Semitic views of another user. Elon Musk did push back and said that he, at the time, had quickly clarified what he meant in a longer form series of posts that the media ignored. The main takeaway is that in an expletive-laden answer, he basically said that he was disinterested, and I'm paraphrasing, John, as I'm sure you can appreciate.
Sure, yeah.
The advertiser flight that we've seen on the platform. He called out Bob Iger. Well, we believe he called out Bob Iger, saying, "Hey, Bob, I'm sure you're in the audience somewhere," in reference to Disney's CEO. But, you know, the idea and what I'm hearing from people inside X, the platform and company formerly known as Twitter, is that this is Elon Musk putting the principles of the company above money, above profits. And you will note the post that X's CEO Linda Yaccarino made after Musk's appearance, saying, and indeed calling it, this was an apology and set out what X really feels about the situation. And again, a reiteration from Musk, he is in no way anti-Semitic.
Ed, I thought 60 seconds later was a lot more interesting, and I'll tell you why. 60 seconds later was more interesting because he started to say that advertisers, and he alluded to this, he didn't say it explicitly in quite the same way, but he basically said that advertisers in corporate America seem to be more interested with the perception of doing good and not people who are doing good, and talked about the success of Tesla and his leadership there. This leaves Disney in a really, really interesting position. Ed, what's the next move from them and Bob Iger?
Yeah.
How do they respond to this?
I mean, what X would say in response to that is that even though they're not doing paid advertising, a number of those companies that have been reported to have put their advertising campaigns on hold are still posting to the platform for free. So there's a double standard there. You know, the lead in our story is that Musk is sort of taking a moral high ground where he's saying that it will be the advertisers that kill X, but the world will know that they're doing it because he is doing his own action and behavior out in the open. Again, for our Bloomberg audience, remember the debt. Remember the debt that is sitting with the banks that underwrote this deal that they can't package and sell to the asset managers because there are no buyers right now. Tesla is down another percentage point today. It fell 1% yesterday. I'm not drawing a causal link, but Tesla has traded as a proxy for sentiment towards Elon Musk's words and actions more broadly, even if it hasn't been in conjunction with the EV maker and has been in conjunction with some of his other companies.
Ed, got it. Thank you, mate. Appreciate it. Just going through some breaking news. Let's get straight to it. From OPEC Plus, according to a delegate, I'll go through the headlines. Manus Krani is going to join us in about 10 minutes' time and go a little bit deeper for you. So there has been an agreement, according to a delegate. They've agreed on 1 million barrels a day of extra supply cuts. There's a key line alongside this, that those extra OPEC Plus curbs come alongside the extension of Saudi cuts as well. So let's push that through the commodity market and take a look at crude, WTI and Brent. Crude right now, WTI just pushing about 80 at 79.35, up by 1.9%. Brent crude up to about 84, up by 1.5%, getting closer to 80 on WTI. Going to return to that story in just a moment, so let that sit there just for a second and turn back to earnings. Kroger delivering a cautious outlook. Katie Greifeld has the story. Hey, Katie.
It's an earnings story we know well at this point. The third quarter, it was all right, but it was the guidance that was a little bit disappointing here. Specifically, you take a look at Kroger's third quarter adjusted EPS. That came in at 95 cents. The estimate had been for 91 cents. You also had sales a touch better than expected. But then you look ahead, Kroger's, it did narrow its adjusted EPS range, but the upper end is still the same. And the grocery chain also lowered its guidance for full year same store sales to a range of 0.6% to 1%. In September, that range had been between 1% to 2%. And one of the reasons why they are so cautious is because it was the impact of near-term economic pressures and food at home disinflation. That's a new phrase for me. So that's not necessarily good news for Kroger's margins. And you can see that disappointment working its way through the shares a little bit here, down 0.4% and lower by about 3% on the year, John.
Katie, thank you. Thanks for the update. Let's get you an outlook. Stuart Kaiser of Citi weighing in on the month ahead for stocks, saying this: catalysts will matter, particularly US CPI and an upcoming Fed rate decision. We remain constructive while favouring the Qs and continue to expect a rally through the year end. Stuart, I'm pleased to say, joins us right now. Stuart, good to catch up, as always. You've said for a while, and we've been talking about it, you've said this rally has been built on good data, and when that data turns, you'll be running in a different direction. Stuart, can you tell me whether that data is starting to turn?
Hey, good morning, Jonathan. No, it doesn't really appear so. I mean, you saw GDP yesterday got revised higher, core PCE got revised lower. You know, our economists expect about 200K of jobs next week. So, I mean, the economic data continues to come in pretty well. You know, Abby used the term before, better than feared, and I think that's how you describe probably the first half of this year. The question is, I think, will better than expected data, you know, still help us? And the reason I say that is our economic surprise indexes are still positive, but they've really started to trend lower the last 3 or 4 weeks. So that's probably a combination of the data not being, you know, completely blowout data, but also expectations rising a bit. So, you know, in our view, the data still remains strong. It still means you want to run long equity, but probably the risk reward around that data is not quite what it was a few months ago.
Stuart, how big do you think that window is? And I hate to ask those time questions, so forgive me, but how big do you think that window is to still be constructive?
I mean, for us, it's at least through year end and probably into early next year. You know, our U.S. economists still have a recession in next year starting in 2Q, right? So if you're going to, you know, get into recessionary conditions in 2Q, then, you know, intuitively in 1Q, you should start to see some weakness in the labor market, right? So that's really what we're going to be focused on. It's payrolls, it's claims, it's credit card spending and credit card delinquency. And in our view, as long as that data holds in, you want to be running long equity risk. As you mentioned, if it weakens, you want to get out quick. So I think, you know, definitely first quarter next year, we're going to be on guard just based on the timing of the recession our economists have.
Let's talk about how you want to be long equity risk. Are the winners of the year going to be the winners of the month next month?
That's our view. I mean, we the last month, you know, obviously a very strong return, S&P up, you know, 7.5%, but tech has outperformed by, call it 325 basis points over that time. You know, we don't think PMs are really going to step out of the comfort zone in the last month of the year, so we would expect what's worked this year, which has been kind of large cap tech and growth, to continue to work. Early 24 is a much different discussion, but at least tactically, we still like that kind of tech trade into year end.
When you say turn and move in the other direction once the data starts to turn, Stuart, we know what you're going to move away from. What are you moving towards?
Cash? No, it's a great question. I think, look, if you were to get a weakening of data, I think what you're looking at is the more defensive and rate-sensitive parts of the market that have underperformed, significantly this year, right? So that's going to be your utilities, your staples, your real estate. You look at something like consumer staples; it's down, call it 5% this year. It would benefit from a rotation into defensive areas of the market, and it would benefit if rate expectations started to decline, alongside slower growth data. So I think if you're staying within equities, you're staying in high quality stocks, you're probably buying some of those defensives that have lagged, and you're just going to kind of batten down the hatches for a bit and see how that data plays out.
You and I are having quite a short-term tactical conversation, and that speaks to the seat that you're currently sitting in, Stuart. I just wonder if we can push the timeline out just a touch. There are a lot of year-end price targets out there. This came from JP Morgan in the last 24 hours, 4,200, downside bias. This line stands out. Valuation is rich. The market is assuming a near perfect landing with inflation cooling without a significant impact to demand and pricing power. Stuart, is that the bet that you sense is currently priced in this market?
No, I don't think the average investor is quite that negative on the market, and really they've been beaten into that view by very strong economic data. Definitely understand the logic. You've done a lot of rate hikes, and people are waiting for the next shoe to drop, and assuming that you can't get inflation lower without a significant hit to demand. So, look, I definitely understand that. I don't think that's the base case view for most investors right now. But look, as you mentioned, if you get some weak economic data, the base case view will shift pretty quickly. But, our forecast has, a relatively mild recession in the middle of the year. We have almost $245 of S&P 500 earnings next year, which would be, call it, high single digits to low double digits growth. So that would probably set up for a slightly more constructive outlook, than the one you've described. To me, the more important thing is within our earnings forecast is a broadening out of the earnings base. So it's not coming from 2 or 3 sectors. It's coming from a lot more sectors. And in theory, that should also drive broader leadership of the market. And that'll be something that we really want to take a close look at as 2024 approaches.
Stuart, price changes narratives pretty quickly. That's been the experience of the last month, hasn't it? It's good to catch up, buddy, as always. Stuart Kaiser there of Citi. Just how price has changed narrative. Go back to October. So here we are, October 23rd. We top out on a 10-year yield at 5.0187%. October 19th, back about a week or so. We top out on a 2-year of 525.71. And here we are this morning, 469 on 2s, on a 10-year, 433. Not much has changed in the last month, and yet the conversation has changed radically compared to the data. Look at these moves now. 2-year yield up another 5 basis points, 10-year up around 9 on the session at least. Want to turn to crude. Crude looks like this in the commodity market right now. We've got a bit of a rally for you on WTI and on Brent as well off the back of this decision from OPEC. I've got WTI at the moment on my screen to $79 through that level. Brent crude at about 84.27. Coming up, crude rallying as OPEC agrees on deeper production cuts.
The lesson of 2022 and early 2023 was that we cannot control what happens in the rest of the world, especially as it pertains to the supply of oil, the supply of natural gas.
The latest developments up next.
This is Bloomberg's The Open. I'm Abigail Doolittle. You're looking at a live shot of the principal room. Coming up, an interview with Lyondell-Basell Industries CEO Peter Vanacker. That conversation at 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg.
Breaking news from OPEC Plus. Let's get straight to it. Manus Cranley standing by. Morning, Manus.
Jonathan, very good day to you. Yeah, it looks as if it was the much hyped extra cuts are to come through. OPEC Plus agrees to a 1 million barrel a day of extra supply cuts. It's critically important to understand you have unilateral cuts by Saudi Arabia and by Russia. So the lollipop, as Prince Abdulaziz bin Salman refers to it, is the 1 million barrels of cuts by Saudi Arabia. This is an extra million. It's how does it get distributed? This is about pushing back against the speculators. This is about pushing the market towards deficits in the first quarter of 2024, which they have failed to deliver in the fourth quarter of this year. How will it come down the pike? Just looking at some of the assumptions, talking to Rapid and Energy on WhatsApp at the moment. By our math, the rollover into the first quarter could push us into a deficit of around 500,000 barrels. But of course, this is to try and push back against what's called the contango formation in the market. How does it split down? Looks like the Emiratis may well, we need the details on this, they may well still get a bump in their quota. But we look at the African nations, that's where the critical, important points in this extra million and the breakdown. We're waiting for that to come through. Jonathan.
Manus Cranny, thank you, sir. Let's continue this conversation. JP Morgan's Christian Malik joins us now out of Europe in London. Christian, your first reaction to this, you were looking for cuts. Let's deal with size first. Is this the number you were looking for?
Absolutely. In fact, the way I look at this is the Saudi lollipop has become the OPEC lollipop. And I think in that vein, what's important here is that all of OPEC has recognized that speculators are not conducive to stability in investment, and therefore controlling that price, making it conducive within a range that's healthy is the key. I know we're looking at deficits. I'd sort of say they're not trying to force a deficit. They're not trying to force the price higher. What they're trying to do is protect the price in a range that's healthy for everybody.
Can you talk to me about distribution? Just how important is that just in terms of price? Does it matter at all?
In terms of distribution of the cuts, I mean, I think ultimately what Saudi's done is led by example. Prince Abdulaziz is a great negotiator, and I think the whole of OPEC has now, I think a milestone has been achieved here, right? So first of all, the baselines, this has been 2 years in the making. The exam results are out, and everyone's abiding. Let's see where it all falls. But then to get the baselines right is critical to then understanding the quota, the compliance, and what that actually means. There's no point having quotas when the baselines are wrong. So I think the milestone here isn't necessarily just the 1 million barrel extra cut that we called for 3 weeks ago. The milestone here is that everyone's on the same page in terms of accountability, which if you're trying to be the central bank of energy, that is key.
Let's think about next year and what's on the table right now. So this morning what we get is some better visibility on the future of supply. Then you've got to think about what the demand picture looks like. Based on that, going into next year, is this the deficit that you're looking for?
I think so. In fact, actually, it's more than that. What they're trying to do is preempt, de-risk any potential downside to demand. Demand's going to be okay next year. I think there's been a huge amount of concern around demand. We see it around about 1 million barrels a day of growth. Actually, what's more important is what happens if we see, a car crash in terms of a COVID unwind, in terms of all those cash savings become negative for demand all of a sudden in Q2, Q3. What happens if we see a little bit more volume from GOM, from Brazil, from shale? In that scenario, this cut is key. Now, so in some ways, it's not just mitigating potential demand risk to the downside, it's also mitigating any potential surprises to the upside, particularly in Venezuela, Iran, and Libya, where we've seen more volume than we necessarily expected. So this is about fine-tuning as opposed to some massive preemptive strike on something major that's going to go wrong. Fine-tuning, I think, is the key theme here.
So let's put a bow on it. Right now, WTI 78, Brent crude 84. You've got some price targets. What kind of numbers are you thinking about next year?
I think a range of 70 to 90, particularly given my comments around the surpluses that we could see, is probably the right starting point with upside risk towards 100. I think really key here, John, is not just necessarily how we think of next year. And think of next year as sort of transition year into major tightness in 25 and beyond. So as long as we can hold the rails in 24, particularly with these surprises on both supply and demand, we're now entering into sort of the safe zone in 25 plus. Why? Because we don't see major quantums of volumes coming from shale or outside in terms of non-OPEC, non-US. And I think this is important because what I've sensed from talking to investors is people think OPEC is the sort of on the weak side, so they're sort of on the back foot. If anything, all they're doing is consolidating market share in the medium term, because as we go into 25 and those deficits really start to bite, that's when they decide what to add and by when, and that's when they rein in full control of the range that they're looking to solve for.
You're a deep thinker. Always enjoy catching up with you. Christian Malik there of JP Morgan. Thank you, sir, out of London this morning on the latest decision from OPEC Plus. Another big cut. About 23 minutes into the session, let's get you some movers, some sector price action. Here's Abby.
Well, we do have the sectors nearly evenly split. Since there's 11, there can't be. But at this point, we have 6 to the upside, led by energy on oil's rally on the OPEC Plus cuts. We also have financials, materials higher to the downside, staples down 0.4%, discretionary and services. Let's look at the month, though, John, because it's a banner month. As you know, the S&P 500 heading to its best month since July. That has a lot to do with technology being up 12.8%. But the sector I really want to focus on, real estate up 11.3%. That is the best month for real estate going back to 2011, having to do with rates down.
Abby, thank you. We'll take another look at the calendar the rest of the week. Up next, your trading diary, just around the corner. November just absolutely amazing. One more month to go after today. Your equity market just about positive, about 25, 26 minutes into the session. Positive here by 0.1%. That's the price action. Here's the trading diary, the calendar into the weekend. ISM manufacturing numbers coming up on Friday, plus Fed Chair Jay Powell headlining a busy day of Fed speak. That includes Barr, Goolsbee and Cook. Looking on to next week, Tuesday, we get JOLTS data. Wednesday, US bank CEOs testifying before the Senate. And then next Friday, the payrolls report. A week tomorrow. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.